You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Moose? Mike from The Moose on the Loose. I hope you are doing well today, and I hope that you are ready for this one. I decided to do a deep dive onto Yieldmax. It's actually not related to Canadian investing. Those are option income strategy ETF on US stocks mostly, some other like cryptocurrencies and other stuff like that. But most of it is like common. They take like common names, very popular names, of course, like Nvidia, Tesla, Microsoft, Amazon, Apple, Meta, Google, and name it, right? And they offer you crazy yield. And I hope that you are ready for this, because this episode, I went into that rabbit hole and I got a lot of fun doing calculations and getting the results. And I don't think you're going to believe it. The reason why I started doing this is I've noticed a lot of not a lot, but some dividend stocks rock members started to add that to their portfolio. I mean, when you look at, and we're going to talk about three of those today, Tesla, Apple, and Nvidia. So TSLY, APLY, NVD, you got it, Y. So TSLY, the income strategy ETF based on Tesla, 72.8% yield. Like, you want that, right? 72.8% yield. Kind of crazy. Apple, APLY, 22.7. Like, it's a cheap one. It's like a less generous one, right? But still, 23% yield. Kind of crazy. And Nvidia, 58.8 yield. And they come fairly cheap. Like, the expense ratio on those are like 0.99. So 1% expense fees. So 1% fee for 73, 23, or 59% yield on amazing companies that we all know. So first things first, let's start by explaining what's happening, why the yield is so crazy, and how does it work. When I get those kind of questions, I always tell my members during private webinars, you know what? You need to go and read the prospectus, because it's really important to understand what's the management strategy over there, how they build it, and so on. Well, my friend, the prospectus for this one is 362 pages. So you either have the choice of reading a Game of Thrones book or reading a prospectus about the Yieldmax. But anyways, short version, it's a synthetic long exposure. So the fund replicate the stock price movement with options. They do not own the stock. They do a lot of option strategies. And actually, they will write covered calls. They will buy like a call options. They will do like a lot of option strategies, such as using credit call spreads as well. So they are playing around with a lot of like options and strategies based on what they think is going to happen next with the stock price, in the hope of generating additional income. So that's really the purpose of this, and it's definitely working. I mean, we all have kind of crazy yield. So you may be thinking, well, for Tesla at 73% yield, you have to hold it like 2 years, and not only you have fully covered your investment, but on top of that, you got some money back. So you could just within 2 years, just with the yield, get all your money back and then some. Kind of crazy, right? Well, it's not exactly how it works. And as you know, I love to say there's no free lunch in finance. So let's do a deeper dive into the results, because yes, it's fun to tell me about the strategy and how it works and how cool is that. But what about the real numbers? Because the real numbers will tell you exactly what's the life of a shareholder of TSLY, APLY, and NVDY. So let's get started with this. So first, I did three things with Tesla, Apple, and Nvidia. So the first one is I've looked at short-term results. So the past month in January until yesterday, so February 3rd, just to see during a bad month for all those three companies, how the Yieldmax would react. So for Tesla was down 5.45% beginning of the year until beginning of February. And the Yieldmax was down 4.99. So either like 5.5 down or 5% down, pretty much the same thing, right? Apple down 8.95, and the Yieldmax down 8%. And then you're going to tell me, but Mike, what about the dividend? Because I mean, there's a dividend being paid, like a distribution. Yes, it already baked in. So it's already in that. The minus 8% on Apple, the minus 5% on Tesla, and I'm coming with Nvidia, that is like the shocker one. The distribution is included in this. So it is exactly the return you got, the price plus the dividend minus the stock price that was at the end. Your investment total dropped by 5 or 8%. What about Nvidia? You know, there was like DeepSeek coming up, and Nvidia got like hit hard. Like they lost 600 billion in market capitalization in a single day. Well, Nvidia for that month now is down at 13%, recovered a little bit, and then the Yieldmax minus 15. So during downturn, there's absolutely no protection whatsoever. There's a tiny advantage on Tesla and Apple, and for a major drop for Nvidia, it's actually the opposite. So you lose more with the Yieldmax, including the distribution, than you would. Now let's take a look at since inception, because it's still interesting, right? So Tesla has been the one that was created, it's the oldest, so created in November 22. Apple is in April 23, and Nvidia in May 23. So of course we don't have that much data, but what I found interesting is the Yieldmax on Tesla, total return, 34%. If you were a Tesla shareholder, you would have been up, well, just a slightly 109% instead. So if you have invested $10,000, including the distribution that you would reinvest, that $10,000 in 2025 would be worth 13.4 versus 21% if you were just holding Tesla. For Apple, well, you got the difference between $12,000 versus $13,800 if you hold Apple instead of the Yieldmax. And for Nvidia, well, Nvidia since inception, the Yieldmax up 160%, so you feel like a genius, until you look at the shareholders that hold the shares instead of Nvidia. They were up 308%, so 93% better. So that's the difference between an investment of $10,000 with the Yieldmax brought in like $26,000 today, or being valued at $40,800, so almost $41,000. So you want to choose between 41 and 26. Well, there you go. I did one more step because I really wanted to nail this down. And I was thinking, you know what? Let's dig into the numbers of everything of the past 12 months for Tesla. So Tesla, if you bought it on March 4th of 24, you would have paid $17.87. Throughout those 12 months, because the distribution changed every month, right, based on the option strategy, you would have received a grand total of $10.54, which is pretty cool, which is the equivalent of like 59% yield. 59% yield on the first on 12 months. That's kind of crazy, but what's the price on January 31st? Oh, yeah, sorry. The price was $12.81. So you lost $5 on that. So your real yield would have been the $10 you receive in distribution minus the $5 that you lost in value. So $5.48 for a grand total of like a 30.66% yield. So still amazing. 31% yield on roughly a year of like holding the stock. I'm buying this. I love that, right? But here's the thing. What about holding Tesla instead? So on March 4th, the price was $188, and on February 3rd, the price on January 31st, sorry, the price was $383 and some change, for a gain of $195 per share. So if you had invested $10,000 over about a year between the Yieldmax and Tesla, well, the Yieldmax you would have gotten $14,800, and the Tesla would have been $20,400. So again, almost $6,000 difference over a very short period of time. But then you're gonna tell me, but Mike, I would have reinvested those dividends. I'm not dumb. I would have got all those distribution and reinvested in the Yieldmax to create a snowball. Well, my friend, those numbers already included the reinvestment. So sorry to break it to you, because if you just cashed it for a revenue, well, that $10,000, you would have gotten $5,000, $900, right? For 59% yield, exactly what I calculated. But your $10,000 today is valued at $7,168. So on the one side, you cashed in $5,900, but on the other side, your investment now is valued as $7,000 in some change. And the other one, well, of course, the $20,000, Tesla doesn't pay any dividends, so that's really $20,000. So you would have the difference if you would have just cashed the distribution. Your $10,000 plus the cash that you have received would have added up to $13,000, not $14,800. So the $14,800 include the reinvestment of the dividend. So now, as a conclusion, is it worth it? Well, you minimize your upside. It's impossible that you can get anywhere close to the stock price performance, the company's performance. So you minimize the upside. And when there's a downside, well, I wish we had a longer correction to show, but the short correction of January show you that you have 100% exposure to the drop, but minimized exposure to the upside. So for the sake of receiving a yield, you're just fully exposed to the downside of the stock crashing, but if it goes up, you're not getting the full value of it. So I don't know, put it that way. I'm not going to put words in your mouth, but do you really think it's a good investment? Impossible that you're making as much money as you would have invested in the great company. But on the other side, if the company drops, you're taking the same hit as anybody else. What about the distribution? Well, that's not enough to compensate. And of course, it's going up, it's going down, it's going to greatly vary. Just to give you an example, in October, Tesla Yieldmax paid almost 60 cents, like 60 cents a share. The month after, $1.22. The month after, $1.28. The month after, 72 cents. So you're going up and down all the time. You cannot really use that as a steady stream of income. And in my opinion, it's very, very far from being a great investment strategy. Speaking of which, I know I'm extending today, but I really wanted to nail that to nail that topic. I think it's better to have a really good strategy that works and that you actually know why you're doing this and how it works in your portfolio. So that's why I suggest that you download Dividend Income for Life guide at moosemarkets.com/income. In that guide, you will see the base of my investment strategy, how I came to that conclusion, why I'm doing this, and how I am doing it. So you can replicate a similar strategy for yourself that actually works and actually give you the full benefit of holding those shares. So moosemarkets.com/income. Download the guide for free, Dividend Income for Life guide. And yeah, so that's it. I'm sorry for going above the 10 minutes, but it was really important for me today and I fell into that rabbit hole. Anyways, so all right, guys, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.